Alright guys, welcome back to second video of this online course. And as we discussed in the previous video, we are going to look at price action patterns in this video. So there are quite a lot of them. But before we dive in and understand those patterns, I want to clear a few terms so it becomes easy road ahead. So what are those terms? Those terms are support, resistance, and consolidation. So let's go forward and look what they actually mean. So let's understand support. In the last video, I briefly told you about support, but here is a proper definition of support. And let's understand what it exactly means. So what is support? Support or a support level refers to the price level that an asset does not fall below for period of time. Here asset means any stock or commodity, and support level is a level which refers to price level, which means the current price or the price of that particular stock does not fall below for a period of time. An asset's support level is created by buyers entering the market whenever the asset dips to a lower price. Basically, whenever any stocks market or anything that goes significantly lower than its actual current price, or let's say it becomes undervalued. So that at that point, people start buying in, and as soon as people start buying in, it creates a form of support. And once a support is formed, next time that support level will also, I mean the previous support level will also act as support level for upcoming days or months to come. In technical analysis, the simple support level can be charted by drawing a line along the lowest lows for the time period being considered. The support line can be flat or slanted up or down with overall price trend. Other technical indicators and charting techniques can be used to identify more advanced versions of support. Now, don't get confused just because of this definition. There are, I mean, this definition can be confusing. There are so many jargons in here, but do not get confused. It is very easy and very simple. Once you understand the concept behind it, it is just a child's play. So, key takeaways: the support level represents a price point that an asset struggles to fall below over a given period of time. Support levels can be visualized using different technical indicators or simply by drawing a line connecting the lowest lows for the period. Applying trend lines or incorporating moving averages provides a more dynamic view of the support. Now just ignore all this. Moving averages is a kind of indicator. We'll understand that later. But for now, let me give you examples of support. So what are the examples of support? Let's understand support in a graphical format. All right. So here's the graph and here are support. So whatever that's marked in red color are support zones or support levels. How do we decide that? Let me zoom into this picture. See, let's start off by this. So the market came down until this point, and then maybe the buyers thought, okay, the current price of this particular stock or asset is undervalued at this particular point of time. So let's buy. And then they bought. And just when they started buying, it started to go up and it made a lower point. Now this particular lower point is going to act as a support level for future time or days or months to come. Similar things happened. So here, okay, it fell down, it came down, and here people thought, okay, this is the time to buy. So it went up again. So this is how supports are formed in live market. This is how supports are formed, or even resistances. We'll talk about resistances in a minute, but this is how supports and resistances are formed. When a particular asset goes up or down, it creates those shadows we talked about, and or the highest and lowest point for that given particular point, and it creates supports or resistances. So we'll understand this in more detail with all these images out here. So don't get confused. It is very simple. Let's understand resistance now. Let me zoom in. What is resistance? Okay, resistance or resistance level. Now in simple terms, before we even read this definition, let me tell you that resistance is basically the exact opposite of support. So support is what? Support is where market struggles to fall below that level. We call that level as a support. Resistance is exact opposite. Any level above which market struggles to go up is called resistance. So resistance or a resistance level is the price at which the price of an asset meets pressure on its way up by the emergence of a growing number of sellers who wish to sell at that price. It basically means that whenever there is a resistance level, people are interested to sell at that particular point, and which drives the market down. Resistance levels can be short-lived if new information comes to light that changes the overall market's attitude towards the asset. Now, this is also true for supports. What does this mean? What does this mean? What are they trying to say? If new information comes to light means, let's say there's one stock ABC and a news comes that this stock is giving out good results, good quarterly results. Good quarterly results have come out, and what will happen when the results are good? It most probably will go up. So at that particular point of time, there will be no resistance to stop that particular stock, because people will be so interested to buy that stock that hey, this is given a good result, so let's buy it. And similarly, when a stock gives any bad result or anything news is there, then that can change the dynamics of the market. That can also change the dynamics of support or resistance that are seen on the chart. So news, when we consider news, when we incorporate the factor of news, everything changes. So let's just keep news aside. Let's just focus on technical analysis. In terms of technical analysis, the simple resistance level can be charted by drawing a line along the highest highs for the time period being considered. So as for support levels we used to draw, we saw that lowest low are considered. So in resistance, it's exactly opposite. We have to consider highest highs. Resistance can be contrasted with support. Depending on price action, this line can be flat or slanted. We'll see that later. However, more advanced ways to identify resistance incorporating bands, trend lines, and moving averages. So this is again moving averages and these bands and all these things they're talking about are indicators. So we haven't reached there yet. We'll understand indicators, and when we understand that, we'll just understand all these things. Okay, so key takeaways: a resistance level represents a price point that an asset has had trouble exceeding in time period being considered. Resistance can be visualized using different technical indicators rather than simply drawing a line connecting highs. Now, yes, there are technical indicators, so let's just keep indicators aside because we'll cover them later. Applying trend lines to a chart can provide a more dynamic view of resistance. Okay, so as we saw this image right here, as red colored lines were called supports, blue colored lines here are resistance. Why? Because as you see, those blue color lines are the lines where the market is struggling to cross. It is not able to cross those blue colored line. The blue colored lines are drawn after it has struggled, of course, but that zone, that zone is called resistance because market is not able to break through that particular level. So don't get confused by watching all these things. We are going to simplify it much more in all these patterns, because that is what these patterns are basically various forms and shapes of supports and resistance. So that is why I wanted to clear out support and resistance before we even start with the patterns. And now the last topic is consolidation. So consolidation is basically nothing but price going up and down in a range bound thing between support and resistance. That's it. Consolidation in technical analysis refers to an asset oscillating between well-defined patterns of trading levels, which means uh, any stock or asset that is oscillating between support and resistance, then we can call that as a consolidation. Consolidation is generally interpreted as market's indecisiveness. Yes, because it is neither breaking out of resistance nor breaking down of support, which means neither bulls are confident nor bears are confident of what needs to be done or where the market needs to be headed, which ends when the asset's price moves above or below the trading pattern. Yes, so after a consolidation, if a price breaks above the resistance level, it usually gets a good momentum and continues to go up. Similarly, if it breaks down after consolidation, then it gathers momentum and breaks on the downside. So consolidation is a technical analysis term used to describe a stock price movement within a given support and resistance range for a period of time. It is generally caused due to traders' indecisiveness. So now that you know what all this means, let me give you example of consolidation. Okay, this is what we call consolidation. So here you see the momentum is there. So the price came up, then it formed resistance, then it came down, then it formed support, then it went up, then it came down. So this up down oscillation is called consolidation. And once it breaks out of consolidation, see, as it broke out of this consolidation, what happened? A good up move came. So for these all these patterns, I have tried to gather real life examples. I mean the real chart examples, and not just drawings, because that would just help you understand these charts and patterns even more. So let's start with patterns now. To start off with the patterns, we'll start with double bottom patterns. All right. So what exactly are patterns? Now, to understand patterns, you have to think them as a collective number of candlesticks coming together to form something, to form a representative image of something that we can analyze and take trading decisions upon. So as you can see, these are candlesticks as we saw in the last session. These are candlesticks, and these candlesticks, when they come together, see, we are not analyzing one candlestick over here or two candlesticks over here or a pattern of two or three candlesticks over here, but we are analyzing a collective bunch of them, which means we are probably looking at maybe 50 or 100 candlesticks together. And this is why we call this pattern, because there are so many candlesticks coming together to form a pattern. That is why these things are called patterns. So now, as you can see, we have double bottom pattern right in front of us. So why double bottom? Let's understand that. So the markets came down, all right. They have been coming down, and then they hit a particular point, and then they went up. Okay, so came down, hit a particular point, then they went up, and then they formed resistance again, because the trend, now what is trend? Trend means uh, what the market have been doing since last couple of days or couple of weeks or couple of months. You can define the time frame, but the basic idea of trend is to understand what direction the market has been going in. So here the trend has been negative, and then markets came down, went up, and then formed this resistance, and then started coming down again. Now, as you can see, when the markets hit the bottom for the first time and went up, that particular level starts to act as a support. And then it went up, and then it came down again. So this particular level starts to act as a resistance. So there's this support and there's this resistance. So there's going to be this small consolidation in between. And then markets came down, formed a support, went up, formed a resistance, came back down again. Now what happens is the previous support acts as a new support again, because when a support is formed, it is not for once or one time or two time. It actually lasts for more than three or four times or even five times. So here what happens is the previously formed support is acting as a support again. Market took support at similar levels and blasted above this resistance. So this resistance over here is what we call neckline. Okay, neckline. And why double bottom? Because they have the chart forms two bottoms in a very short amount of time. So first bottom is here, second bottom is here, and it forms a W like shape. So if you can see, it is a W right over here. So W like shape is formed. So this is a double bottom, first bottom, it goes up, second bottom, and then it breaks above this previous resistance we call as neckline. And when it does so, when it breaks the neckline, what we have to do is we have to go long on markets, meaning we have to buy the markets over here and keep the stop loss below this support level. All right. So let me explain this again. Market comes down, forms a support, goes up, forms a resistance, comes down again. Now takes support at the previous support, because support acts as a support for multiple times, and then goes up again and breaks through and breaks above this resistance or neckline. And then we have to buy markets over here with stop loss below this support level. All right. So these are not drawings, these are real charts. So to give you an idea of how real charts perform, I was searching for real charts. So these are all real charts. So you go long here, you place your stop loss order over here. What is the stop loss order? Stop loss order is basically your exit point. Whenever you say that, okay, this is my entry and this is my exit. So to avoid that manual exit, you can place a stop loss order. Basically, where your trade starts to become invalid, that is where you put your stop loss order. So if this trade comes down below this support level, which will mean our trade is not working and it is now invalid. The double bottom that was formed is invalid. So that is why it is invalid and we will exit over here. So that is why we put stop loss over here and go long over here. Targets can be the highs of previous highs of this particular trend, uh, but you have to keep patience until then because the market can test patience. As you can see, the red candle over here, it went up, came down, and then slowly went up. So these, uh, uh, what what we can say, these price movements and fluctuations are always there. So you need to be careful and be patient with your trades. So this was a double bottom. Now exactly opposite of it is a double top pattern. Now what is a double top? Let me find it. It is here. So double top pattern is basically exact opposite of double bottom. So double bottom was W and double top, as you can see, is a M-shaped pattern. You can see an M over here. Yes, so what happens is the trend was positive from this side. It went up, formed a resistance, first resistance, came down, formed some support, went up, and now when it went up, the previous resistance was there, so it acted as a resistance again. It could not break above these levels. Now as you can see, it formed some shadows and wicks over here, but it could not give a proper close. The body could not close above this resistance, which means there was not enough buying pressure. Whenever buyers tried to push it hard, the sellers were interested in selling it again. So until and unless we get a close above any support or resistance, it is generally considered to be not valid. So we did not get any close over here, and then the market fell down again. And here, as you can see, it broke that support level or neckline. And when it broke that neckline, what happens? So in a double bottom thing, we went long because it was a bullish pattern, but this is a bearish pattern. So what we can do is we can short the markets over here and then cover it later on the downside. So I hope you're getting this. Again, these you do not have to analyze each and every candlestick, uh, or two or three candlesticks or a bunch of them. You just have to look a collective number of candlesticks, like maybe 50, 100, 200, or sort of that thing. Now let's move to next pattern. So next pattern is, let's take this bullish flag pattern. So what is a flag? If you if you can just imagine flag, how does a flag look? Flag has a pole and then it has that cloth uh, on the top of it. So this is exactly how a flag looks, right? So this here is the pole. So what happened? Markets went up. So the pole has been formed and then it consolidates. It oscillates. See, support, resistance, support, resistance, support, resistance. It oscillates, forming new supports and resistances, and it keeps oscillating between those. So after forming a flagpole, which is one-sided buying came over here and then it consolidated. So now as you can see, the trend is positive. The trend is positive, and after that it consolidated. So up, down, up, down, up, down, and it finally broke above the resistance level over here. So these zones, it broke above the resistance that was getting formed. And bullish flag pattern, this is called a bullish flag pattern because the trend has been positive. So we have to stay with the trend, right? Trend is our best friend. So that is why this is a bullish pattern, that we have to stay with the positive trend right over here. So there's this positive trend, there's this consolidation, and there's this breakout. And after it broke out, as you can see, it went up. So uh, when it breaks out above this resistance, you can place your stop loss order somewhere over here and go long. Now exactly opposite to this bullish flag is a bearish flag pattern. Now what is a bearish flag? It is exactly opposite, like double tops and double bottoms. A bullish flag and bearish flag work exactly opposite. So here is it. As you can see, this we can call as a flagpole. Okay, then there was this consolidation, a new support was formed, a resistance was formed, and there was this oscillation of candles going on. And as soon as it broke below this particular support, what happens? Momentum comes. Now this is a bearish flag. Bearish flag meaning meaning the main trend is negative, so you have to look on a short side. The trade that you're looking is going to be short selling trade basically. So what is short selling? I guess you guys know short selling, but short selling is basically exactly opposite of buying. So when you buy something, you sell it later and make money. Short selling is you sell something first and then cover it later and then make money. So it's exactly opposite of going long. We call it going short. So this is a bearish flag pattern. So this was this down this pole over here, and then the consolidation support between support and resistance, and as soon as it broke this support, it went down. Now you might think, what if it breaks above this resistance? Do we have to buy? The answer is no, because the main trend is negative, and when the trend is negative, we do not have to make any buying side call or any buying side trade. When the trend is negative, we have to search only for short selling or short side trades. And over here, bullish flag pattern over here, similar thing. Like if it breaks below this support, can we sell? No, you cannot sell or you shouldn't sell because the trend is positive, and when the trend is positive, you should not be selling the market because you have to stay with the trend, because trend can show its strength at times you are not even expecting it. So let's say it breaks below this support and you short the markets, and then what happens is it goes down for some time, and then immediately a big green candle is formed and you are helpless. So don't go against the trend, always stay with the trend. So what we have seen as for now, we have seen double bottom, double top, bullish flag, bearish flag. Now we see bullish pennant and bearish pennant. Now this bullish pennant and bearish pennant is very similar to the flag pattern. The pole is there, except for flag, which was a rectangular consolidation thing. This is a triangular consolidation, which means the price consolidates and the candles keep getting shorter and shorter, which literally means they are consolidating into something that is about to blast. Okay, so this call this something like a pressure cooker for price action. So what happens when a pressure cooker is kept tight for a long amount of time? It explodes. So that is what happens here. Again, you have to look at the trend. So the trend is positive. The pole has been formed, huge buying. Then this pressured consolidation over here, up, down, up, down, up, down, and finally breaks above this resistance. And this is where you have to go long. Okay, this zone is the zone where you have to go long or buy and keep your stop loss below the lows of this resistance. And then you can just keep trailing your stop losses as soon as the market keeps going in your favor. So this is bullish pennant because the trend is positive. We go on the long side. Even if it breaks on the downside, you are not, you shouldn't be shorting because again, as I said, it is against the trend, and trend can show its strength at times you are not even expecting. So this was bullish pennant. Let's understand bearish pennant now. Bearish pennant again is exactly opposite of bullish pennant. So this is downtrending market. Then there is this heavy selling pressure. The pole has been formed. Again, pressured consolidation, up, down, up, down, up, down. And then this zone, as you can see, a candle. This candle is a completely bearish candle that closed below this support or support zone. So this is the zone where you can start selling. This is where you can keep your stop loss order at, and then what happens? The market starts to go down. Now this is Nasdaq 100 chart. So this is again a real chart, a live chart. Uh, so I took live charts or real charts because they are literally history, uh, representation of history of what has happened in previous times. So, and as we say, history repeats itself. It is at least true in cases of charts. So these patterns keep repeating themselves over and over again. So you can make trading decisions based on these patterns. So we have understood many patterns now. Let's understand ascending triangle pattern. So the concept here is same. The concept among all these patterns is literally the same. There is going to be some kind of trend before the pattern forms. Either it's going to be uptrend or downtrend, and then there is going to be a sort of consolidation. Consolidation can be in triangular form or in rectangular form or anything, but consolidation is going to be there. And after consolidation, whichever side it breaks out, you should take that trade, not really whichever side. I should say that's the side of the trend. If the trend is positive, look only for positive side. If the trend is negative, look only for negative side. So like here, this is ascending triangle because as you can see, the triangle is facing upward. This is ascending triangle. So this is uptrend. Then there's this new resistance it forms. Then here it forms new support, and then it oscillates between it, and a pressured consolidation is seen. And after it breaks above this resistance, you can see the uptrend continues. Again over here, if it breaks on the downside, you shouldn't sell because a big green candle can form anytime to just kill you out. So this is ascending triangle. Let's now see descending triangle. So this is again, these patterns are exactly opposite of each other. So as you can see, this is descending triangle. Now this is not a classic descending because the trend was positive over here, but I took this image because I wanted to show you that sometimes it works despite being against of the trend. So this is not to tell you to trade against the trend, but yes, if you do some mistakes over the learning period, then it is not a, what we can say, it is not something that you shouldn't have done. Of course you can avoid, but that also works sometimes. So this is a positive trend and then a descending triangle which broke on the downside. So see, it also performed, but here is the green candle which I am talking about. So as you can see over here, this big green candle, such candles can form anytime. Such candles can form even when you're not expecting, because the trend is positive. They can literally form anytime and just push you out of the markets. So that is why staying with the trend is advisable. Going against the trend is not advisable. Now here we have a rectangular pattern, a rectangular consolidation pattern. So I don't need to say why it's rectangular because it is pretty clear. The consolidation that has been found is in a rectangular shape, and it, when it breaks above the resistance, it goes up. Now because the basic trend was positive, here the trend continues. If the basic trend would have been negative, then it would have went down. We would have shorted it when it broke below the support. So it works exactly opposite. Then there's this cup and handle pattern. Now you have to visualize a cup over here, and then this is its handle. So cup and handle pattern. Now this is a different kind of pattern because it moves in a circular kind of way, and then it consolidates in this slanting channel kind of way. This is called a channel. And then when it breaks out of this consolidation, it continues its upward trend. Okay, have a look at it. It's cup and handle. The basic concept is going to be same. There's going to be some kind of trend, there is going to be some kind of consolidation, and then there is some kind of breakout. So you have to stay on the side of trend. So like here the trend is positive, so you have to stay on the positive side. But as you can see here, if you see clearly over here, these wicks or these zones, the market actually broke down. So there might have been some people who sold over here, thinking that okay, it broke below support, let me sell and make some money. But this is what happens when you go against the trend. It immediately came up, went up and made a green candle, and trapped all these people over here. So that is why it is advised to not go against the trend. So as we have cup and handle, we have inverse cup and handle as well, which is exactly opposite of cup and handle. So cup and handle is a bullish pattern, and inverse cup and handle is a bearish pattern. So as you can see, the trend has been negative, it has been falling, then it makes a circular kind of shape, then consolidates in a channel and breaks down, and then goes down again. So cup and handle and inverse cup and handle are exactly opposite of them. Like all these patterns are opposite to each other. There's this falling wedge and rising wedge pattern. You do not have to remember these names again because as I told you yesterday, I mean in the previous session, that you do not have to remember the names as far as you understand the concepts behind it. Not remembering names is fine. This is a wedge pattern, so similar kind of thing. A trend plus a consolidation plus a breakout, and a pattern is formed. So rising wedge pattern. So a trend, downtrend, consolidation, and a breakdown. So these things are going to be very common. You're going to see these things very often when you are into live markets. Alright, so I forgot to mention this one pattern. and I did not wanted you guys to miss on anything, so I am making this video separately. But here is the head and shoulder pattern. Now what is this pattern? As you can see, the trend is positive, okay, and then it forms a sort of shoulder, then it forms a sort of head, and then again it forms a sort of shoulder on the same neckline, meaning it forms a support, and then based on that particular support it makes up shoulders and heads. So what is a shoulder? It goes up, it comes down again, okay, as it is mentioned over there. Then it goes upward of that shoulders high, and then comes down again, and then forms another shoulder, and then it breaks below that neckline. And when it breaks below that neckline, we can take a short side trade or initiate a short. So this is how this head and shoulder pattern works. And just like this head and shoulders, there is this inverse head and shoulder pattern as well. So there's this inverse head and shoulder, and this is a bullish pattern. Like the head and shoulder was bearish pattern, this is a bullish pattern where you can see a neckline is formed. Now it need not be a horizontal neckline, it can be a slanting one as well. And you can see here the left shoulder is there, then the head is formed, and then again the shoulder is formed. So just like a human head and shoulder, like we have head between our two shoulders, and the head is on the upper side of the shoulder. That is the exact concept of head and shoulder. As you can see that there's this head between those two shoulders. Similarly, this is inverse head and shoulders, that is why it is completely ulta thing. And then when the neckline is broken, I mean the left shoulder is formed, head is formed, and right shoulder is formed, and once the neckline is broken in inverse head and shoulders pattern, you can go long. Alright, so I hope you have understood all these patterns, and I did not wanted you guys to miss on anything, so I recorded this pattern as well. So I hope you learned these patterns and have understood what they mean, because understanding the concept is very important. And like yesterday, or like the previous session, why am I talking yesterday? Like the previous session, I'll also link one channel to the description, where that guy has also covered these patterns, and he has covered in short. So I like that guy's playlist, so I'm attaching it below so you can have a look at that as well. And if you haven't understood anything, then you can just replay this video, and then maybe if you have doubts, then ping me. But I hope there should not be any confusion, because these are pretty simple, or easy to understand things. These are just made confusing using the jargons and heavy English language. But once you understand the concept, it is pretty easy. So I hope you understood this particular session, and hope you learned these patterns, because we are going to use these patterns in our upcoming sessions as well. If you haven't, then please feel free to replay this video and watch it again. There's uh, no limit to what you or how much you can watch. Just replay until the concept is getting clear. Okay, so I will see you in the next session. In next session, we are going to discuss. Let me see. Let me see what we have on the table. The basics are clear. I mean, the candlesticks are done, candle patterns are done. In the next session, okay, we'll discuss indicators. We'll understand indicators, moving averages, MACD, RSI, and all those things. So it is going to be interesting. So before we get there, make sure your concept is clear. If you haven't understood candlesticks or candle patterns, please spend some time in there. Do not hurry to close up this course, because if you don't understand these basic things, it is going to be difficult up in the upcoming sessions. So get the context clear, get the concepts clear, and then head on to the next session. So I will see you in the next session. All right, bye bye, take care.